How do we take investment decision in capital assets? It's by looking at the cash flows. So how do we arrive at those cash flows? Let's see. At first we will arrive at sales, deduct expenses, then compute the profits. Let's say this is profit after tax. Now this profit is arrived after deducting depreciation, which is a non-cash item. So let me add back that depreciation as well as amortization. I'm adding back because non-cash items have to be excluded while arriving at the cash flows. Similarly, this profit is arrived after subtracting interest on long-term sources, which is used for funding the capital asset. So let me just add back interest on long-term loans. What is the reason why I am adding back? See, after finding this cash flow, we will be doing something known as discounting that you will understand gradually. And that discounting will be done using a particular discount rate which already factors the interest on long-term loans. So when it is already factored, and if I'm not going to factor that here, if I'm not going to add it back, then that could lead to double counting of interest in our analysis. Okay, so for that reason, following the long-term funds principle, I am adding back interest on long-term loans. And there is also one more element. This profit is after considering the sales and expenses, right? And this sales can have some unrealized sales information, and this expenses can have some unpaid expenses also. So we have to provide for that as well. So we call it as changes in working capital, which can be a plus item or minus item. So changes in working capital. If I provide for all this, I will get to know what is the cash flow from operations or the cash flow available for analysis.